Welcome to Market Recap. I'm Daniel.
Then I'm Mira.
There's this classic saying in markets that sometimes you hit the accelerator expecting the car to smoothly speed up, but instead, well, the engine violently seizes.
Yeah, and you just go flying right toward the dashboard, which honestly perfectly describes Friday, June 5th, 2026.
It really does. It was the ultimate, good news is bad news day. We got an economic engine running so hot and so fast that it completely shattered the market suspension.
Right. A blowout jobs report turned a highly resilient economy into a really severe, broad-based market sell-off.
So today we're pulling from a huge stack of overnight geopolitical wires, that explosive 8:30 a.m. Eastern Time labor data, and some late-breaking corporate filings. We want to understand exactly how that all happened.
Because the cross-currents today were just intense. Our mission for this deep dive is to really extract the signal from the noise for you.
Exactly. We're going to show you how trade tensions, global currency stress, and a hawkish bond market collided in real time.
All while, mega-cap tech companies just kept plowing billions into AI, acting like nothing else was happening. Understanding the why behind these massive moves is going to be crucial for navigating next week.
It absolutely is. But before we get into the mechanisms of today's market action, we need to explicitly state to you, the listener, that this show is strictly for market context and discussion.
Yeah, this is not personal investment advice or an investment recommendation. We're just here to help you understand the baseline you're operating against.
Perfect. So it really is wild how quickly a narrative can flip. We went to bed Thursday thinking the Middle East was cooling down, but Friday morning told a completely different story. So what set the stage before the U.S. session?
Well, to understand the sheer fragility of the U.S. market open, you have to look at the unresolved Middle East narrative that carried over from Thursday.
Right, because just a day earlier, President Trump was publicly claiming that the Iran ceasefire talks were going exceptionally well.
Yeah, he even stated that the Strait of Hormuz would open immediately.
Which is a massive deal. I mean, the closure of that strait has been choking off roughly a fifth of global petroleum liquids. The market desperately wanted to believe that supply constraint was finally lifting.
But by Friday morning, the reality on the ground looked radically different. An advisor to Iran's supreme leader actually went on CNN and stated that the talks were completely deadlocked.
Wait, deadlocked over what?
Over a $24 billion dispute. And they explicitly threatened to drag the war beyond the Persian Gulf if the conflict resumed.
Wow, and things actually escalated beyond just rhetoric, right?
They did. Around 7:24 a.m. Eastern Time, Iranian state media started claiming their Navy had fired warning shots at U.S. destroyers in the Gulf of Oman.
Which forces a response. U.S. CONCOM had to issue this rapid-fire denial. They clarified they only conducted a standard right-of-visit boarding of an Iran-linked vessel.
Exactly, and they had to warn that an actual attack would violate the standing ceasefire.
When headlines like that drop, it's so tempting to view these geopolitical events as unpredictable natural disasters.
It is, but if you look at the sequence of events, both sides are aggressively posturing, using the media and military movements to squeeze out better ceasefire terms.
Right. It perfectly illustrates geopolitical brinkmanship as negotiation leverage. The deadlock isn't necessarily the death of the talks.
It's just the friction of the final negotiation.
Yeah, that's a great way to reframe it. It's high-stakes poker, but the chips are global energy supplies. And while the oil markets were digesting all that tension, the global supply chain caught another massive curveball.
Oh, the tariffs.
Yep. At 5:51 a.m. Eastern Time, U.S. Customs and Border Protection confirmed sweeping new tariffs on aluminum, steel, and copper.
And these go into effect incredibly fast. Like this coming Monday, June 8th, the Swiss government is already scrambling. They're actively negotiating to protect their domestic industries from the fallout.
Just think about the mechanics of this for a second. Aluminum, steel, copper, these are the absolute bedrock materials for the industrial economy.
Right, so when you slap a sudden tariff on them, that acts as an immediate tax on production.
Exactly. Manufacturers can't just absorb those costs. They have to pass them down the line to the consumer. And for a Federal Reserve that is terrified of sticky inflation, they simply cannot ignore these new import costs.
They have to defend central bank credibility as an inflation anchor. They just have to.
Which brings us to the broader theme here. Intense global stress. And nowhere was that more visible pre-market than in the currency markets.
Yeah, late Thursday, moving into Friday morning, the Japanese yen violently breached the 160 level against the U.S. dollar.
Yeah, the 160 level is a massive psychological barrier. I know we saw a suspected intervention by Japanese officials, but how does that actually work in practice?
Well, mechanically, when a currency plummets that fast, the central bank has to step in and create artificial demand. Japan literally has to dip into its foreign reserves.
Which are mostly U.S. dollars and treasuries.
Exactly. They sell them off and use that cash to buy their own yen to prop up the price. And to give you a sense of the scale of this panic, the Bank of Japan just reported its largest drop in foreign reserves since the year 2000.
Wow, since 2000. So they are essentially burning the furniture to keep the house warm?
That is a perfect analogy. The U.S. dollar is so strong because our interest rates are so high. It's exporting inflation to the rest of the world, widening the gap between U.S. and foreign monetary policy.
And Japan is paying the price just to stabilize the floor.
Yep.
So before the opening bell even rang in New York, you had geopolitical brinkmanship threatening oil supplies, new inflationary tariffs locked in for Monday, and the Bank of Japan burning decades-old reserves just to fight off the U.S. dollar.
That highly fragile pre-market setup leads us directly into the main event.
It really does. So what moved markets during U.S. trading hours?
The absolute epicenter of the day was the 8:30 a.m. Eastern Time May U.S. employment report. We were expecting a relatively cool number, something around 88,000 jobs.
But instead,
non-farm payrolls surged by 172,000.
I mean, that almost doubled expectations.
It completely shattered the models. And it wasn't just the headline number either. Average hourly earnings ticked up 0.3% month over month.
Which means wage inflation remains incredibly sticky.
Exactly. Meanwhile, the unemployment rate held completely steady at 4.3%.
And the immediate market reaction was just violent. You do not often see fixed income move this aggressively. The 10-year Treasury yield immediately surged to 4.536%.
Which drove the U.S. dollar index up to 100.07.
And equities just suffered severe drawdowns. S&P 500 futures gave up over 2,000 points in a heartbeat, dropping from an intraday high of 7,591 down to 7,359.
The VIX Volatility Index, which tracks market fear, spiked from a sleepy 15.8 to over 21.5.
Even gold, traditionally a safe haven, got absolutely crushed by the surging dollar. It dropped from over 4,508 down to 4,336.
And the driver behind all that destruction was the bond market.
Yeah. I know we frequently talk about how higher yields compress valuations, but for anyone listening who gets a headache looking at bond math, how exactly does a jump in the 10-year Treasury mechanically crush a tech stock?
Well, it all comes down to how investors value the future. When you buy a share of a mega-cap tech company, you're mostly buying a claim on the cash they're going to generate 5, 10, or 20 years from now.
Right.
But a dollar earned a decade from now is obviously worth less than a dollar in your pocket today. To figure out exactly how much less, investors discount those future earnings by a risk-free rate of return.
Which is why we often refer to discount rates as financial gravity.
Exactly. When the 10-year Treasury yield spikes to 4.5%, investors can get a fantastic guaranteed return just by holding government debt. So they become far less willing to pay a premium today for a tech company's distant, risky future earnings.
The math mechanically forces the stock price down.
Precisely.
Yeah. So a red-hot economy means higher yields, which ironically makes the companies operating in that economy worth less on paper today. And that dynamic triggered a hawkish repricing of epic proportions.
The 180-degree turn in sentiment was breathtaking. Traders abruptly shifted from hoping for imminent rate cuts to suddenly pricing in a higher probability of additional Fed tightening.
Wait, they're actually pricing in hikes again?
Yeah. The market is now looking at a potential rate hike by January. Fed official Hammack actually hit the wires, warning that it may soon be appropriate to act against high inflation.
Oh, wow.
BNP Paribas immediately updated their models and forecasted 3 rate hikes starting in December.
No, we have to look at this impartially and report the full spectrum of the reaction because the White House took a completely different stance on this data.
Very different.
White House senior advisor Hassett came out and aggressively downplayed the inflation threat. He called the current gas prices a mere short-term disruption and framed the 172,000 jobs as evidence of a supply-side boom.
The administration's argument is essentially that robust economic health will eventually expand supply enough to absorb demand, averting runaway prices without the Fed needing to hike.
And as observers, we have to neutrally report this stark contrast. On one side, the administration is offering reassuring rhetoric focused on long-term supply expansion.
And on the other side, the bond market is in absolute panic, pricing in near-term rate hikes.
Frankly, relying on an eventual supply-side miracle to avert inflation while the labor market is running this hot feels like a classic case of markets pricing ahead of physical reality.
I agree. The bond market doesn't have the luxury of waiting for a theoretical boom in 2027. It has to deal with the 172,000 jobs and the 0.3% wage growth happening right now.
The physical reality of today's inflation is superseding the theoretical relief of tomorrow. And that is why risk assets paid such a heavy price across the board today.
Yeah, the bond market is definitely back in the driver's seat, and risk assets are taking the hit.
All right, let's take a very short break right here. When we come back, we'll transition away from these massive macro forces and look at the specific corporate developments that played out.
Sounds good.
And we're back. So what is the corporate events recap and what to watch next?
Well, the most fascinating irony of the day is that while the macro landscape was melting down, Silicon Valley was basically operating in an alternate universe.
It was stunning to watch. Mega-cap tech essentially ignored the surging 10-year yield and the macroeconomic panic. They focused entirely on their own massive infrastructure buildouts.
It perfectly illustrates AI capex as a cycle-agnostic arms race playing out in real time. They simply do not care what the bond market is doing, they are building.
And the scale of the capital involved is mind-bending. During U.S. trading hours around 10:35 a.m. Eastern Time, news broke of a colossal cloud computing deal between SpaceX and Google.
Colossal is the right word. We are talking about $920 million per month.
Wait, almost $1 billion a month?
Yeah, running from October 2026 all the way to June 2029. To fulfill a contract of that size, Google has to supply SpaceX with a staggering 110,000 Nvidia GPUs.
Alongside all the CPUs and memory infrastructure required to run them?
Exactly. The demand for compute is so insatiable that the SpaceX IPO is reportedly swelling to twice its initial $75 billion target size.
Speaking of Nvidia, late Thursday around 5:47 p.m. Eastern Time, just before Friday's session really kicked off, Nvidia CEO Jensen Huang announced massive expansion plans in South Korea.
Yeah, they're building new R&D centers, automating chip production, and integrating their robotics tech into massive Korean industrial giants like Hyundai and Samsung.
But as Nvidia expands its global footprint, domestic scrutiny is also tightening. Senator Elizabeth Warren formally invited Huang to testify before the Senate Banking Committee on June 11th.
They want to look under the hood of Nvidia's China operations and check their compliance with export controls.
So regulatory friction is building, but it clearly isn't slowing down the spending. Around 2:03 p.m. Eastern Time, Reuters dropped a report that Meta is considering raising tens of billions of dollars in a new stock offering.
And that's specifically to fund its AI infrastructure. They are also floating the idea of charging up to $200 a month for a new planned consumer AI assistant.
That potential Meta stock offering is a critical mechanism for listeners to understand. When a company issues tens of billions in new stock, it dilutes the ownership percentage of everyone who currently holds shares.
Right, this is equity issuance as mechanical dilution. It's a stark reminder of tech mega capex masking market fragility.
These companies look invincible, but corporate capex as a systemic liquidity drain means they are literally sucking billions of dollars out of the broader market just to fund these data centers.
They need the cash, and they are entirely willing to dilute their own shareholders to get it. It's a massive vacuum cleaner for capital.
It really is. And to top off the AI news cycle, at 1:53 p.m. Eastern Time, President Trump announced plans to host major AI companies at the White House next week.
The goal there is to propose a public-private AI partnership, effectively treating these tech giants as critical national infrastructure.
Bringing the government directly into the fold of Silicon Valley's infrastructure race.
Yeah, like you said, they're operating in an alternate universe.
Honestly, today was one of those days where a strong economy is officially your portfolio's worst enemy. We got a jobs report so good that the stock market decided to immediately file for unemployment.
Yeah, no kidding.
On the bright side, with the White House hosting tech executives next week, maybe they can ask an AI model how to unhike interest rates.
Good luck with that.
Right. If that fails, we can always just buy Meta's rumored $200 a month AI agent to tell us comforting lies about our 401k balances. Hang in there and enjoy the weekend because at least Saturday and Sunday are safe from the Fed.
We all definitely need the weekend to recover, but the economic calendar does not pause. So here's what you need to watch next. On Saturday, June 6th at 4 p.m. Eastern Time, Fed Governor Michael S. Barr is giving a speech on supervision and regulation.
Then, right at 12:00, 1 a.m. Eastern Time, on Monday, June 8th, those massive U.S. tariffs on aluminum, steel, and copper officially take effect.
That is going to be a major immediate test for materials and industrial equities right at the open.
Also on Monday at 3 p.m. Eastern Time, the New York Fed releases its consumer inflation expectations for May.
And shortly after that, at 3:30 p.m. Eastern Time, the U.S. Treasury holds its 3-month and 6-month bill auctions.
Watching investor demand for short-term government debt will be critical given today's massive yield spike.
Absolutely.
That brings us to our bonus session, paper trading. Every day we take 2 minutes to test if our macro analysis actually generates alpha or if it's just noise.
Let's see how we're doing.
As of today, June 5th, the paper portfolio value sits at $10,841.24. Our current return is 8.41%, which is nicely outperforming the S&P 500's return of 3.62%.
It's a really solid lead. But today's macro shift requires some defensive maneuvering.
Exactly. I'll start with my decision. I am selling 10% of our technology ETF, ticker XLK, and I'm buying 10% of the financials ETF, ticker XLF.
Okay, what's the logic there?
The mechanism here is straightforward. The blowout jobs report means discount rates will stay higher for much longer. As we discussed earlier, that higher financial gravity is going to mechanically compress tech multiples.
That makes sense.
Conversely, the financial sector directly benefits from higher interest rates because banks can earn a wider net interest margin on the money they lend out. I am, however, holding our energy allocation, ticker XLE.
Right, because of the Hormuz gridlock.
Yes. The deadlock in the ceasefire talks means we have to treat energy shocks as a delayed consumer tax. Keeping XLE provides a hedge against that exact threat.
Well, I agree entirely with the sell on XLK and the buy on XLF, so I won't repeat the rationale. We absolutely have to respect the multiple compression danger.
Glad we're on the same page. What about your holds?
For my side, I almost holding our utilities ETF, ticker XLU. Even with extreme interest rate volatility, energy access is the AI bottleneck. All of these massive data centers that SpaceX and Meta are building require dedicated power infrastructure.
Which ensures utilities remain systematically vital regardless of what the Fed does.
Exactly.
All right, so our final aggregate decision for the portfolio. We will sell $1,082 of the technology ETF, XLK, and buy $1,082 of the financials ETF, XLF. These trades will be executed at the close on Monday, June 8th.
Perfect.
And as always, a quick disclaimer to you listening. This is a live internal experiment and not financial advice. Past performance does not guarantee future returns. Do not copy these trades.
It is entirely about testing the thesis in real time.
We started this deep dive talking about the violent whiplash of an economic engine seizing up while you're hitting the gas. But if mega-cap tech companies are starting to act like their own sovereign nations, completely immune to the Federal Reserve's interest rates, what happens when they finally run out of cash to burn?
It's the multi-billion-dollar question.
We'd love to hear how you are navigating this terrain. Let us know your thoughts on today's massive rate hike repricing in the comments below.